It is no secret that this province needs money. The deficit, after all, is north of $11 billion. We're told the appetite to raise taxes is a pretty tough sell. And with that in mind, the Ontario government has announced a plan to fund costly public transit projects through the sale of so-called green bonds. And joining us now for more on the viability and practicality of these bonds, in Hong Kong via Skype, Toby Heaps. He is co-founder and president of Corporate Knights. And with us here in studio, Sonia Galati, senior economist with the TD Bank, and Matty Semioticki. He's a professor of geography and planning at the University of Toronto. And it's good to have you two here in studio. And Toby, it's the middle of the night for you. What are you doing in Hong Kong anyway?
I just woke up. I had a nap. I was worried I overslept.
No, you're doing just fine. Thanks very much. Let's, just before we get into this, play a little snippet of the economic statement where this idea of green bonds was rolled out. Roll tape, please.
Another innovative source of funding would be green bonds. Ontario would be the first Canadian province to promote and sell these bonds. Good idea. These are highly attractive and an economical way to invest in our transit projects.
Finance Minister Charles Sousa from the economic statement. Toby, why don't you start us off? He said the timing was right for this to be rolled out now. What's good about the timing of these green bonds now?
Well, there's really been a surge in investors who have an appetite for green bonds, investment-grade bonds that are investing in climate change solutions, things like transit, things like renewable energy, things like transmission infrastructure. And so this is a well-timed bond because there's been a surge over the last 5 years in demand, and it doesn't appear to be falling off at all.
Sonia, Toby says there's a surge, but I note that obviously Ontario wouldn't be the first jurisdiction in the world to bring these forward if in fact it happens. The first green bonds were, I think, first issued a decade ago, and I think in all of that time since, only 9 financial institutions around the world are actually participating in this. So are they really that hot or desirable?
I think right now they are quite hot, but I think what you alluded to is the fact that they are only 6 years old. They are a very immature financial instrument, but I think people are jumping on this particular bandwagon because there is a need for environmental financing. There is a gap right now, and the public sector can only do so much given the austerity and the expenditure restraint. So people are looking at green bonds right now to fund the important infrastructure investments like transit.
Well, we do have a graphic up right now which suggests that yes, they're not that old. Interest hasn't been fantastic for most of the 7 years they've been around, but in 2013, yes, there is quite a spike there and a lot of interest at the moment. What's your take on it, Matty?
I think this is an interesting and innovative idea to raise money, but I think it's really important to keep in mind this does not alleviate our financial pressure. This is a financing strategy rather than a funding strategy. These are a really important distinction. Financing is the money that comes up front to pay for infrastructure, whereas funding is really the money that you have in the bank to pay this money back, the revenue streams that you have. The problem with transit is that transit doesn't recover its operating costs, let alone its capital costs. So even if we have the money coming in through these green bonds, we still have to have the revenue streams, the long-term money to pay for these bonds. We still have to have that money coming in. And that's the broader conversation that really has to be we have to be having.
Toby, is that to suggest that even if the public really goes whole hog for these green bonds, it's really not going to help the bottom line, the deficit, very much at all?
Well, yeah, it's the green bonds it's not a replacement for raising the money from the public by any stretch. But in a province that borrows upwards of $35 billion a year, when you can broaden your pool of investors, particularly your commercial investors, the green bonds are a welcome development. The other thing about green bonds that's interesting is an Ontario residence. When I buy an Ontario savings bonds, I have no idea where that money is going. It's going to some amorphous thing called Ontario, and some people are happy to do that. But a lot of other people would be really happy to know that they're buying Ontario green bonds, if the retail option exists, and their money is going to build the transit that they ride every day, and they have an investment stake in that. And I think this is a really interesting development to use bond markets to help to connect citizens to actual infrastructure projects that affect them on a daily basis.
Matty, it is a fair point to say when you buy an Ontario savings bond, you don't really know where that money's going or what it's being invested in, but you sure know what the rate of return will be. They tell you what it is, very small, obviously, very modest, but you know what it's going to be. Do you have any expectation that you'll have the same guaranteed rate of return when you buy a green bond?
I think that's going to be the real question is, are the bond markets and the investors willing to come to the table and invest in these types of bonds? What do they see as the backing? What do they see as the revenue streams? Ontario doesn't just have a large deficit, it also has a very large debt. We have a good credit rating. People are still willing to invest here. They're still willing to pick up the bonds of the province of Ontario. We already have bonds to invest in infrastructure. Infrastructure Ontario has a bond facility, has a borrowing facility that they can lend money to municipalities to pay for infrastructure. So the question really is, what is this bringing new to the table that we don't already have available to us?
What do you think the answer to that is, Sonia?
And I would think that the answer to that is investors are guaranteed that these funds are going to be used for green projects. You can't say that about a corporate bond. You can't say that about a government bond. It's money going into a black box, and investors are not necessarily invested or interested in where the money goes. All they're interested about is the risk that the bond carries and the return for their particular investment. But green bond investors are interested about risk, they're interested about return, but they want the social aspect to it, of the social return that they're investing in this particular case, it's green bonds. And there is a monitoring and auditing process embedded in green bonds so that investors do know that the money that's going, where exactly it's being used. So it's another layer for transparency for the actual borrowers.
How about your bank? Are they interested in playing in this sandbox?
I think, as I said, it's a very new financial instrument. I think if we as a bank can portray a green bond that's attractive to our clientele and our institutional investors, then that's something that we can explore in detail. But I would say that the province of Ontario, the first government in Canada to try it, I think it's an important test for the Canadian market to get a sense about demand for green bonds. Right now, all we know is the world, and we know that $5 billion of US dollars has been done by Canadian corporations, but it hasn't been really tested, and I think this is an important first test.
Toby, how much money do you think green bonds could raise here in the province of Ontario?
Well, I think it could entirely replace the Ontario Savings Bonds, or certainly could replace half of the Ontario Savings Bonds program, and then which is the minority of the $35 billion that the Ontario issues every year. The majority of the $35 billion is sold to places like Canadian Pension Plan, like Case, Addenda, large institutional investors, insurance companies. I think you wouldn't want the green bond with its specific debt for purpose, because it ring fences and it does tie government's hands to some extent to hold them to the account that money is going to go where they promise the bond market it's going to go. And the government does need some flexibility. So I would say probably somewhere in you could get to $10 billion a year before you would have any kind of consequences in terms of flexibility for the government.
And how much evidence do you have that the international investing community is actually interested in playing in this?
Well, there are about 100 large investors, and we're talking about State Street, BlackRock, Sun Life, CPP, including about 10 large investors in Canada, folks who have assets north of $30 billion, who've expressed an interest in buying these types of bonds. But critically, these types of bonds have to have the same financial properties that the regular Ontario bonds have. So that means they have to pay the same coupon, or roughly the same coupon. And it's important that they be exchangeable and have liquidity for these institutional investors.
Gotcha. All right. I want to read a comment now from Ann Golden. I think everybody knows who she is. She's heading up, I think, the second, maybe third consultation that the province of Ontario is doing right now to figure out how to pay for all the rapid transit that people say they want. She didn't want to be a guest on the program, but she did give us this statement about the subject we're talking about today. The Transit Investment Strategy Advisory Panel, that's her group, is pleased that the province is exploring new financial instruments to support transport expansion. We, of course, will be eager to learn that these green bonds can apply to transit expansion in the Greater Toronto-Hamilton area. The panel is exploring the use of a new revenue stream to leverage debt for the purpose of helping build the region-wide transit network that the GTHA so desperately needs. Okay, Maddie, what do you infer from that?
I think she's right. I think it's exciting that we're looking at new opportunities to bring money into the system. But again, this isn't new money. This is money that's going to have to be backed by revenue streams. And I worry a little bit that this conversation about green bonds distracts us from the broader conversation of what are those revenue streams specifically for transit in the GTA and across the province.
In other words, this is not a replacement for either higher user fees or higher taxes to pay for all of the transit we want.
We have to have a way to pay back the borrowing that we take, no matter what mechanism we use to borrow. Transit in this region recovers less than 70 cents on the dollar for most systems outside of Toronto. In Toronto, it's around 73 cents on the dollar, just on operating. That has nothing to do with the capital cost to actually pay to implement these systems. So overall, we still have to have ways of bringing in new money, and this is the broader conversation that the Golden Task Force was meant to have, and I do worry a little bit that this distracts us from that conversation by focusing on what role green bonds can play in that conversation.
Toby, do you share that concern?
I don't think that has come across as the intent. That's not the way I've read it. Nobody's ever talked about these green bonds being additional debt. They'd have to be additional debt if they're going to be replacing funding streams for transit. The actual cash flow, whether it's coming from different types of taxes and fee levies that were recommended by the Toronto Board of Trade and different think tanks like Pembina Institute. So this is not at all additional debt. This is just carving out the substitute for existing debt and imposing some discipline on it. But yes, we certainly need to generate the cash flows to be able to pay back these debt holders that will come from the Ontario tax base and also from the various revenue tools that have been discussed for Metrolinx.
That's the next concern, and I want to put that to you, Sonia, because you co-authored a report for the TD Bank on this issue of green bonds, and your comment is, green bonds provide a steady stream of capital over many years, allowing projects to be launched and kept afloat before they become profitable.
Right.
Now, those last few words there, before they become profitable. Subways, streetcars, LRTs, dedicated buses, they're never profitable, right? You're not going to turn a profit running those systems.
Right.
So how does this work given the context of what you just laid out?
So that was primarily speaking to a lot of the corporate demand for green bonds. But when you take a look at it from a public sector and you think about it from the economist lens, this is a public sector good. People are going to have some incentive to actually build these transit and build this transportation, given the fact that we're all benefiting from it as a society as a whole. So I think that's sort of taking a look at it. I agree with you that it's not necessarily profitable, but I don't necessarily think it should be a drain on the public purse. So even if you were able to just get a net zero return or recover your costs, I think that's important for the Ontario government perspective, given everything else they have going forward, especially with the pressures on public spending.
Let me just make sure I understand that, because transit systems don't break even.
Right.
I mean, technically, they lose a lot of money. They've got to be subsidized by taxes. So is that a disincentive somehow for these green bonds to hit the market and play a meaningful role?
Well, when you think about it from a project perspective, for instance, a specific line on transit or a specific bus route, so you have to get very specific. And so I think in terms of that, perhaps you can actually get a net zero return in that respect.
One of the other issues that's come up, Maddie, around green bonds is who gets to decide? I get that all the money that's going to be raised will go towards so-called green projects, public transit, for example. Who decides what's green enough to qualify?
I think this is really one of the outstanding questions. Is all transit green? What about transit that's running diesel trains? There's been a large conversation about that in Greater Toronto. Is that considered a green project? And who's going to audit these projects to make sure that once they're operational, that they're actually still running green? These are some of the issues that still need to be worked out around this funding mechanism or financing model, really, and these green bonds, is how really they're audited to ensure that they're actually as green as we think they are.
Toby, you got any answers? I'm sorry, go ahead, please.
And if I could just add to that, I think the definition of green is one of the biggest challenges about green bonds, because green means something very different to one person versus another, but yet you use this label of green bonds, it means something very different, but yet it represents a collective financial instrument. So I think as the green bond market matures, I think the definition of green bonds has to be crystallized and standardized, and I think that's what we're speaking to in the fact that it is a very immature market, and there are these wrinkles that need to be ironed out. But the definition of green is very challenging. Is it project specific? Do you want to dissect it to make sure everything is green? Is it a threshold of 80% has to be green? I think those are the questions that really need to be asked.
One of the questions I have too is how deep is the commitment to green within these financial institutions? They talk a lot about investing in green projects. This is seen as part of their branding. This is seen as really
Her pin's green.
A way of...
Yeah, they're all over that at TD, aren't they?
That's right. It's part of their corporate social responsibility mandates. They've signed UN principles, a lot of the pension funds, to say we support these types of socially responsible investing. But the question is, how deep is it when it starts to impinge on their returns? If these projects if these bonds start to have have lower returns than other types of bonds, will they really still support these? Will they really still put their money where their mouth is in terms of investing in these projects?
Okay, a lot of good questions here. Let's go to Toby in Hong Kong. Have you got some answers on any of these questions, Toby?
Yes, thanks, Steve. So the first thing, just to make crystal clear, the people who buy these bonds, whether they're Ontario residents or institutions, them getting paid back has absolutely nothing to do with Ontario Transit becoming profitable or being a net benefit to Ontario, which would be a high probability given that we have $6 billion of lost productivity every year. They get paid back guaranteed by Ontario and Ontario's balance sheet. So when you buy one of these bonds, you're getting paid back from Ontario, full stop. That's unless Ontario goes belly up, and there's not a high probability of that happening, and this program is not increasing debt. In terms of certification and labeling what is green, great question, because there's a danger if you don't have certification that there can be greenwashing. So there are a few emerging certifications. One that the World Bank uses is called the CICERO certification, and it has various categories, including renewable energy, but certain types of renewable energy like large hydro, they're being careful on. And I think because it's early days, this is a nascent space, that it's probably the 80-20 rule. And to Maddie's point, would a diesel train be green? Well, that's a good question. It's probably greener than not having a train, but I would suspect that Metrolinx and the Ontario government are going to be careful to direct these initial sources of capital to projects that won't be controversial, like diesel trains. There's lots of rail, there's lots of infrastructure, hard infrastructure that needs to be built that can suck up these green bond capital sources. And I would think it would be unlikely that controversial ones would be picked when there's so many uncontroversial places to start.
Toby, I hear you, but let's say, for example, I mean, I don't think it's the case today, but once upon a time, the Toronto Transit Commission subway trains ran thanks to the energy they derived from coal-fired generation. Now, it's public transit, so it's supposedly green, but you certainly had to belch a lot of pollution into the atmosphere in order to create the power to make those trains run. So would that be considered a green project?
I don't think that would pass muster with most reasonable people as a green project. There is something called the Climate Bonds Initiative. It's a global initiative and has a governing council, including a significant number of the world's largest investors. And they are developing meticulous, detail-oriented guidance for each category of green bonds, including transit. And so that's something to watch. The World Bank, CICERO standards, has a reasonable level of detail, not quite as detailed as what the Climate Bonds Initiative is going forward. And that's something to watch. And I know that the Ontario government is exploring these various options because they're quite intent on making sure that these bonds are 100% bona fide green bonds, and that there's a clarity for the market. And so there'll be a broader base of investor demand to buy these green bonds and no suspicions of greenwash.
Maddie, you wanted to follow up.
I did. I'm still struggling a little bit to see how this is much of a game changer. If the bonds are entirely backed by the province of Ontario and we still have this large deficit and this large debt, it doesn't change any of that situation. It brings in money up front, but yet we still have to have the long-term revenue tools. We still have to have the funding to pay this money back. We already have investors who are still willing to invest in Ontario. Even with the deficit and the debt, Ontario still has a bond rating that can attract investors. We can still bring in money to invest in these projects. When we do infrastructure investment on a project-by-project basis, we do have things called alternative finance and procurement models where the private sector is investing directly in projects already. So we've seen this in transit projects already. We have seen this taking place to this date, and I wonder how this is really changing the game by calling these green infrastructure bonds.
Toby?
I have a point I'd like to make. James Carville, who used to work in the Clinton White House and was his first campaign manager for the White House, he said he used to think when he died he wanted to come back as the Pope or 400 hitter in baseball, but he realized no, he wanted to come back as the bond markets because the bond markets have a lot of power. And when the government makes a promise to the bond markets, it means it's going to happen. A few years ago, Maddie, I think you'll recall, the Metrolinx budget had its carpet pulled out from under it, and it was because the bond markets were worried that the Ontario was going to violate some of its covenants, and they said, you have flexibility here to cut or delay this capital spending, and if you do it, we will not cut your rating. And so Ontario did it because they had flexibility. If they've made a promise to bond markets that money is going to go into these things, they don't have that flexibility. So this imposes a new order of discipline on the government to deliver on these promises. And it's not just words anymore. Now you have the bond markets backing it up, and that's a serious force.
But the allegation was, not the allegation, the suggestion was that this may not be the game changer that its proponents are painting it to be. What do you think?
Well, I was at the press conference with the Premier and the Minister of Finance and Minister of Transport, And I didn't get the whiff that it was a game changer. They talked about this being one of a variety of tools that would help to make the transit strategy possible. And this is something that would deepen and broaden the pool of investors. There's still a need, an important need, as Maddie brings up, to raise the revenue for transit. We can't just go and spend $35 billion on transit and not have ways to recoup the revenue. And the Toronto Board of Trade and the various political parties and a lot of the people in the civil society sector are all on the same page there. And I don't think this is in any way at all. This is the strategy that goes together and complements the funding tools that will be necessary to generate the cash flows to recover part of the expenditure to upgrade our transit and increase our productivity.
Okay, I've heard the expression greenwashing, Sonia, used twice already today. I just want to make sure everybody knows what that means. Greenwashing to you means what?
So, for instance, you have a company who is already planning to do an investment, make a purchase, for instance, of changing the windows of their buildings, and now they realize that, hey, there's a green element to it. They were already planning on doing it. Now there's a green element to it, and they issue a green bond as a result. So it's no net new investment, no net new purchases, no net new improving the environment. They were already planning on doing it, but now because it's very popular, they're going to be labeling it as green. And so the idea here with green bonds is you want to be doing new green investment, something that you hadn't previously done because of this new financial instrument. In greenwashing, the thing would have already been done. They're just jumping on the bandwagon.
So they would enjoy a kind of a good housekeeping seal of approval being associated with these green bonds when in effect, they're not bringing anything new to the party, so to speak.
Absolutely.
Huh. So how do you avoid that?
I think the idea is, greenwashing does serve a positive in the sense that it adds credibility to a market. It shows investors that, hey, there's been demand. All of these investments were previously occurring, and it would be going forward. But I think it sort of goes back to the question we were saying before about what is actually green. And I think we're going to be coming back to that particular point throughout the entire show, is because if one person defines it as one thing and another person defines it as another, you always have that ambiguity, and people will continue to say, hey, it's green, but it's according to my definition. Even when Toby was sort of talking about previously about, hey, you have the Climate Bonds Initiative, they have their own criteria, OECD have their own criteria. As long as you have all of these different criteria, there is no standardization, and everyone can be mentioning the term green bond, green financing, but really referring to very, very different things.
Have we made a decision yet about whose standards and criteria we're following?
No, I think the green bond market is too immature at this particular point. I think they're trying to get a sense as to how large it can really be, whether this is a financially viable financial instrument, and as it grows higher and demand increases, I think borrowers and investors are really going to drill down on the specifics.
Maddie, the suggestion that if these are green bonds, they are kind of closer to God, if you like, does that suggest that other kinds of bonds are dirtier?
I was wondering that as Toby was speaking about the purpose of green bonds. I do wonder about what their role really is going to be and how much the financial institutions, especially the big pension funds, are going to look at these and say, this is a good form of investment because it furthers both our bottom line and our corporate social responsibility. We are seeing pension funds speaking about this. They're being pushed by their members, they're being pushed by their boards to think about how they integrate the environment, how they integrate corporate social responsibility into their investment programs. But it really, in the end for them, comes back to the returns. They see this as the pension promise. That is their number one priority, is to return money back to their members so that they can enjoy their pensions that they were promised. And they see that really as their foremost goal. The environment and other corporate social responsibility objectives are important to them, but they're really secondary.
And I would echo that. I would say if you take a look at who's in the bond market, 72% of our institutional investors. When you take a look at these pension funds, mutual funds, they have a responsibility to their clients to maximize return and minimize the risk that's present. So I think investors are going to look at the market and say, is the return there? Is the risk there? Find two very comparable instruments. If there's a green element that doesn't sacrifice the return or the risk, I think you would actually have a pension fund willing to do that. But as I said, risk comes first, return comes second, and then you sort of have an institutional investor say, okay, is it green?
One thing that is important to keep in mind is from the provincial perspective, using bonds to finance infrastructure really is an appropriate way to do it. We've increasingly used private capital to finance the upfront costs of infrastructure, and that comes with really high premiums that are much higher than if we were to use the province's borrowing rate. So using bonds is an appropriate way to finance some infrastructure. But the question is really, what is it backed by? Given our deficit, given our debt, what are the revenue streams and revenue tools that we're really talking about that are going to allow us to pay that debt back? back.
So this does not absolve the province of still answering the larger questions that we've been grappling with now for several years.
I think that's the key conversation that has to be having. And as I said earlier, I worry that this defers that conversation and really puts this notion of green bonds front and center and muddies the water about the difference between funding and financing. That's the part of the conversation that's really, I think, tripping us up here in this region, is people saying, oh, we can use this to bring in new money. But it's not new money if it's not backed by a revenue stream to pay it back.
Toby, you want to address that?
Sure. I think it's important that I come from the media as well. I think it's important that we're part of a public conversation here, and we should recognize that Ontario has done something that took some level of courage. Most finance ministers and premiers are really reluctant to say that we are going to ring fence and take our freedom away from money that we collect, whether it's from tax sources or from bond markets. But instead of going to the general kitty, we are going to put this in a special box, and we promise for sure it's going to go there. That takes a level of courage, and there haven't been a lot of governments in Canada. I think Ontario is the first to do that, and so they've done this, and then we're having this discussion, trying to turn it into what were their ulterior motives. And I really think this is an example of good public policy, and it's part of a larger emerging trend, and it's something that makes sense to, I think, us just as normal citizens too. When you think about it, I'm more comfortable giving money to the government, whether it's through taxes or through purchasing a bond, when I know what it's going for, just like I'm more comfortable giving money to a charity when I know what it's going for. And this is part of a general trend towards greater financial accountability in the public sector. It's not about transforming all of our tax dollars to dedicated purposes or all of the bond markets, but it's about giving a modicum to that so that we can have some intentionality and some accountability to the capital flows, which is really important to see things get done.
I hear what you're saying, and I wasn't suggesting, and I don't think Maddie was either, that there was any kind of ulterior motive behind what the government was advancing here, other than the question of how much uptake do we really think there's going to be on this, given that, if we've learned anything through the Great Recession, it's that bondholders aren't particularly particular about where their money goes, but they sure are about getting it back. Plus, they want their rate of interest, and they are not particularly fond of taking a haircut, as we've learned over the last 5 years. So how much uptake do you think there's really going to be on this?
Let's do a straw poll right here. So, Steve, let's say it's time to do your RSPs, and you have a choice. You can buy an Ontario savings bond, and it pays a coupon rate. I don't know what the coupon rate is, but let's just pick a number, say 2.5%. Or you can buy an Ontario green savings bonds that pays a coupon rate of 2.5%. Now, both bonds are both guaranteed by the Government of Ontario and have nothing, the guarantee and the promise to pay you back and the risk factors are identical. So you have the identical risk factor, identical return. Which bond do you want to buy?
I'm going to answer your question with a question, which is, are you sure that the rates are going to be equal? Because usually if there's some aspect of social responsibility associated with a financial instrument, you've got to take a little less in order to feel a little purer. So answer that.
I would say no, because here you're not taking any kind of a haircut on the risk factor. So if you were saying we're going to issue the green bond and you're going to get paid back through cash flows from a tax on a congestion charge or some sort of related tax, then that would be different, and you could expect to get a different rate of return. But what the government is looking at saying here is you are going to get an identical rate of return, backstopped by the exact same entity. So it is exactly the same as a plain vanilla bond. The only difference is this has a green flavor, and you know 100% with 100% confidence that all the money you put in is going towards the infrastructure as specified in the green bond prospectus. So there's no difference on risk, no difference on coupon, and that's what they're looking at right now. And that's how you should start, because financial markets, you have to move incrementally. You can't move too radically or people can get scared.
I'd love to answer that question, but I see Maddie wants to get in first. So you go ahead.
Well, one thing that comes to my mind is continuing to think, does this really displace the need for other borrowing? Even if we float these green bonds, we still have a capital program that is considered not green. And so where's that money going to come from? Are we still going to be floating non-green bonds and green bonds?
Sounds like it.
And if these really take on this additional green flavor and investors like these more, are we going to then have to boost the rates of our other bonds to get people interested in this? If everyone wants to flock and invest in the green bonds for their own personal motivations to feel better about their investments, what happens to the other part of our capital programs?
Is it your understanding, Sonia, that, given the choice, the way that Toby laid it out, you can get a regular bond for 2.5% or you can get a green bond for 2.5%. If you get the same,
right,
why not go for something that sounds greener? I mean, is that likely to be the choice at the end of the day?
I think it would appeal to ethical investors, people who are interested in social investors, but they have that choice. But I think when you take a look at the World Bank issuance, they're the biggest issuance so far of green bonds. They've taken a haircut. In a lot of the green bonds that they've issued, they're actually less than the benchmark treasury. Because what they're doing as an institution is trying to get the market to gain traction. And as a result, they're willing to take a haircut and provide less of a return. And so in that particular case, you're really just going towards the people who are ethical investors who are interested in the green element.
Are there enough of those around?
I don't know. I mean, right now we're in a low interest rate environment, and so bonds are very attractive. But we haven't talked about the elephant in the room of what about in 5 years down the road when bonds are less attractive and people flock to equities? And so in that particular case, a return is that much more important. And if there's even a small difference in a negative sense between a regular vanilla bond and a green bond, you're going to be that much more sensitive as a result.
People would go for the vanilla, you think, in that case?
I think so.
Even if you could make if it's a difference of a quarter of a point, that would make enough of a difference for people to go one versus the other?
If you think about, as I said, the bond market, 72% of our institutional investors, they're not dealing with dollars here, they're dealing with billions of dollars.
Right.
Every single basis point of a percentage point difference makes a difference to their clients. And as I said, they have a fiduciary responsibility to maximize the return.
Toby, just in our last couple of minutes here, you and I guess others are going to be going out there and making the case. How much skepticism do you think you're going to find out there as you try to make the case for green bonds?
Well, I think we should just take this with a sober perspective. Now, there's some people who hear green and they think this is a niche market. This is for people, the little widowers and priests. No, that's not what this is for. We're talking about a $200 trillion capital market space. We're talking about the balance sheet of the government of Ontario. We're talking about a $35 billion borrowing program. This is not a niche for ethical or socially responsible investors who comprise 1% of the market. This is something for everyone who rides transit, who cares about infrastructure. There is no reason for a haircut to happen on these things. And Sonia, I would take note, most of the recent issues, the issuer has actually had some slight financial advantage in terms of saving a few basis points. And so investors have been willing to pay a little bit more for this. I personally polled 10 of Canada's largest investors, including the ones you would think of, and ones that have to do with pension funds that affect all of us. And they said, yes, certainly, they would be quite interested in investing in this as long as it has the same risk properties and the same financial properties. I mean, who wouldn't want to have the green premium when you don't have to pay extra for it? And I know that ideally the person who heads up the Ontario Financing Authority, he would like to get actually a slightly lower cost of financing because they're adding a benefit. There are so many investors out there who have made strong commitments, who understand that we need to make a transition to a low-carbon world, and this provides a no-risk way of doing it because you're not sacrificing on risk. The province is backing it up, and you don't have to sacrifice on coupon because the province is looking to get this market kickstarted. This is the hassle to go to get these bonds certified green, and I do see them commanding a premium. The last couple of issues have commanded a premium and provided slightly lower financing costs for the folks who have done them. Massachusetts did a green bond issue to tap into this $1 trillion pool of capital, and they found it was way oversubscribed, while their plain vanilla issue, which was larger, they had to cancel because there wasn't the broad investor interest. So we're seeing a secular trend among institutional investors for more dedicated purposes of finance, and there is money that would not come into Ontario, big money that will come into Ontario if they can get that green certified label. And so this is just a smart way of broadening the investor base. And it could be a great opportunity as well for Ontario citizens to be able to participate in crucial infrastructure that affects us on a daily basis.
Matty, that's a pretty solid sales pitch. I'll give you the last 30 seconds if you want to retort it.
Sounds really compelling. It's passionate. I really appreciate that. I think we should be doing stuff to improve the environment. I think our question is how we pay this money back. The bond revenue that's going to be coming in is financing. It's upfront cost to pay for the upfront cost of infrastructure. What we don't have is the way to pay it back yet. That's the broader conversation that's happening, and I hope it happens louder and more frequently and in the media and all over the place to really raise that question of how are we going to pay this money back. Green bonds are a nice way, a really innovative way of bringing the money in at the beginning. We need to come up with the long-term strategy to pay back our debts.
Gotcha. Thanks, everybody, for coming in and helping us understand this issue a little bit better, starting with Toby A.A. Heaps, the president of Corporate Knights, who either stayed up very late or got up very early. It's the middle of the night in Hong Kong. Toby, thanks for doing that for us. Sonia Galati, the senior economist at the TD Bank, Matty Simiatiki from the University of Toronto. Thanks so much, everybody.
Thanks, Steve.
Thank you.
Thanks, Steve.
Support Ontario's public television. Donate at tvo.org.